Hello and welcome to our vodcast on interpretation of accounts with Sam Sherratt, Andrew Parker and Ryan Chamberlain. So what does the interpretation of accounts actually mean? Well, it can be simply expressed as a detailed explanation of the financial performance of an entity incorporating data and other quantitative and qualitative information extracted from both internal and external sources. When looking at interpretation of accounts, it involves four main stages. First of which is collecting the information, second is analysing it, third is interpreting it, and fourth is reporting the findings. Collecting the information is just a fairly general review of the international economic, financial, political and social climate, and more specifically one of the country in which the entity operates. So when you look at collecting the information, you should ask yourself the following questions. First of all, is the government supportive of the industry? Is there an expanding market for its products? Is there sufficient land and space available for development? Is there reliable infrastructure? Are there grants and loans available for developing enterprises? And finally, is there an available or trained labour force nearby? Analysing the information is literally just putting all the information you have collected and making sense of it and putting it all together. There are four main ways of analysing data. First of all is horizontal analysis, second is trend analysis, third is vertical analysis, and fourth is ratio analysis. Interpreting the information literally means you interpret or explain what has happened in your findings so far. Now, some of the questions you might ask yourself in this stage of the process is, what does it tell me about the company's performance? Has the company done well compared with other financial periods? How does it compare with other companies in the same sector of the economy? Are the world economy, political and social circumstances favourable to trade generally? What are they like for this company's industry? And finally, what are the prospects for this region in which the company does its business? The final stage is reporting your findings. This usually comes in the form of a written report, and then when you write a report, there's usually three main sections you follow. The first section is an introduction in which you outline the nature and purpose of your report, including a brief outline of its structure. The second part should contain your discussion, in which you present your information and your assessment of what the evidence means. And the third part is your concluding section, summarising briefly the entire study, list your conclusions and state your recommendations. Now, when looking at profitability ratios, there are four main ratios involved. The first is return on capital employed, the second is gross profit, the third is markup, and the fourth is net profit. The best way of assessing profitability is to calculate the ratio known as return on capital employed, or ROCE. It can be expressed quite simply as profit divided by capital times 100. This ratio is usually expressed as a percentage and is one of most importance. Even though there is not commonly agreement on how it should be calculated, the problem is that both profit and capital can be defined in several different ways, and as a result, a variety of return on capital employed ratios can be produced merely by changing the definitions of either profit or capital. So to help us out, there are four other definitions of return on capital employed. The first of which is net profit before taxation divided by shareholders' funds times 100. This definition measures a pre-tax profit against what the shareholders have invested in the entity. You use this if you want to know how profitable the entity is and has been as a whole. Second can be shown as net profit after taxation divided by shareholders' funds times 100. This definition is similar to the previous one, except that it measures post-tax profit against the shareholders' investment in the company. Taxation is normally regarded as an appropriation of profit and not as an expense. The tax payable will be based on the profit for the year, and a company has no other option than to pay it. The distinction between tax as an appropriation and tax as a profit is blurred, and some accountants prefer to use this definition as a measure of overall profitability. However, you have to bear in mind that the taxation charge in the accounts can be subject to various accounting adjustments, so you'd have to be careful using this definition in comparing one company with another. The third one can be shown as net profit after taxation and preference dividends divided by shareholders' funds minus preference dividends times 100. This definition can be used if you want to assess how profitable the company has been from an ordinary shareholder's point of view. It measures how much profit could be distributed to ordinary shareholders as a proportion of what they have invested in the business. And finally, the fourth one can be shown as profit before taxation and interest divided by shareholders' funds plus long-term loans times 100. This definition measures what profit has been earned in relation to what has been used to finance the entity in total. Interest is a cost of borrowing money, so it is added back to the profit made. Similarly, long-term loans are added to the shareholders' funds because this gives us a total financial investment in the entity. You use this definition if you want to know how profitable the entity has been in relation to what it has taken to finance it. And the next ratio we're going to look at is the gross profit ratio. The gross profit ratio enables us to judge how successful the entity has been at trading. It can be calculated as follows: gross profit divided by sales times 100. The gross profit ratio measures how much profit the entity has earned in relation to the amount of sales that is made. However, if you are going to use published accounts, sales may be described as turnover, and the cost of sales may well include production costs. Therefore, you must be wary if you are going to use published accounts, as you must make comparisons between the different companies. The next ratio is the markup ratio. The gross profit ratio complements another main trading ratio, which we will refer to for convenience as the markup ratio. This is calculated as follows: gross profit divided by cost of goods sold times 100. Markup ratios measure the amount of profit added to the cost of goods sold. The cost of goods sold plus profit equals sales revenue. The markup may be reduced to stimulate extra sales activity. This will have the effect of reducing the gross profit. However, if extra goods are sold, there may be a greater volume of sales, and this will help to compensate for the reduction in the markup on each unit. Owners sometimes like to compare their net profit with the sales revenue. This can be expressed in what is going to be the next ratio we look at, called the net profit ratio. This is calculated as net profit before taxation divided by sales times 100. It is difficult to compare the net profit ratio for different entities fairly. Individual operating and financing arrangements vary so much that entities are bound to have different levels of expenditure no matter how efficient one entity is compared with another. So it may only be realistic to use the net profit ratio in making internal comparisons. Over a period of time, a pattern may emerge, and it might then be possible to establish a trend. If you use the net profit ratio to make intercompany comparisons, make sure you allow for different circumstances. In published accounts, you might also want to substitute operating profit or profit on ordinary activities before tax for net profit. Now we're going to show you a sporting example of interpreting company accounts and using the profitability ratios. Here you will see the profit and loss account for the year to the 31st of March 2012 and the balance sheet at the 31st of March 2012 for a sporting company. Now, in order to work out whether the company performed better in 2011 or in 2012, you must calculate the profitability ratios for both years. So now you can see the return on capital employed ratio for both 2011 and 2012. So the net profit before tax divided by shareholders' funds times 100 for 2011 equals 10.2%. However, in 2012 that has increased to 15.4%. This therefore measures of profit show a healthy return on capital employed in both years, with a bigger increase in 2012. Although we don't know from this how this compared with other companies. The increases may have been partly due to a significant increase in markup on sales, and if so, this would suggest that the company is selling in an elastic market and that it is being able to increase its selling prices without any great difficulty, resulting in an increase in sales. And next, the gross profit ratio, which is gross profit divided by sales times 100, shows 40% in 2011 and 43% in 2012. Now this clearly shows that the gross profit ratio has considerably increased in 2012. And then the net profit ratio, net profit before tax divided by sales times 100, shows in 2011 18.1% and in 2012 23.5%. And similarly, the net profit ratio shows a healthy increase, indicating that operational expenses are under control despite the company being busier. So we'd like to thank you for watching our vodcast on the interpretation of accounts and also on the profitability ratios. We hope you enjoyed.